In chapter 3, we're going to start talking about the balance sheet. Now, the truth is, what we talk about mostly the income statement and the balance sheet in this um, course, but we sometimes touch a little bit on the cash flow statement. Intermediate 2 talks a lot more about the balance sheet, but we're going to get into some of the balance sheet during this semester. And so, first of all, what is a balance sheet? It's sometimes known as a statement of financial position. So, it lists our assets. Now, these are listed in broad categories. So, you're not going to see, eighth inch pipe wrench or, eighth inch wrench, all that kind of stuff. Listed. It's going to be very broad categories: property, plant, and equipment. So that would include all the buildings, all the machinery, all that equipment type of things. It's going to have your cash listed. It's going to have your accounts receivable listed. It's going to have inventory listed. It's going to have another number of things that is listed. So it's going to be the statement of financial position. And what you're looking to see is a positive and growing owner's equity, growing retained earnings over a period of time with years. And that's what you're going to see in a healthy company. And the balance sheet is very important. If we go on the assumption that the financial statements are prepared correctly, then it is almost impossible to deceive an investor or a creditor as to the financial condition of the company. Now, if in the case of fraud, then all bets are off. But assuming that we're honestly preparing the financial statements, if you just look at any one individual statement, it could be misleading. But if you take all four of them together, it's very hard to deceive somebody as to what's going on. So that's one of the reasons that you want to take a big picture approach to things. So the balance sheet lists all of our assets, all of our liabilities, and our owner's equity, and puts them into context. So let's talk a little bit about assets and how they're classified. Assets are classified into two classifications: current assets and long-term assets. A current asset is anything that can be satisfied in, or that's going to be used in 1 year or within a accounting cycle. For most businesses, we just use the 1 year cutoff, but the accounting cycle concept is important. So long-term assets will be things that are used over a period of time. A piece of machinery might last us 7-10 years, right? A building might last us 40 years. And so those tend to be long-term assets. Now, on the balance sheet, you will be one of the things you'll be asked in this chapter is to prepare a classified balance sheet. And so when we talk about a classified balance sheet, it means splitting it up between the current assets and the long-term assets, and the same on the liabilities, current liabilities and long-term liabilities. Now, when you list assets, you list them from the most liquid to the least liquid. So what do I mean by the term liquid? It means things that can be easiest converted to cash. So obviously cash is the most liquid asset. And when we do cash and cash equivalents, which we'll talk about in a future chapter. But a cash equivalent is something that is essentially the same as cash. Money market accounts that have maturity of less than 30 days, that's essentially a cash. Credit card receipts, that's going to be turned into cash immediately. Those sorts of things are all cash equivalents. Treasury bills with less than 30 days. One of the important things to realize about a cash equivalent is that the chance that its true value will deviate from its face value is essentially nothing. There's not going to be a difference between the face value and the actual cash value listed as to what it is. So we list from the most liquid to the least liquid. So the most liquid will be cash and cash equivalents. Second most liquid is generally accounts receivable. And then third comes inventory. And then we go down the list, prepaid, current assets, that sort of thing. Then in the long term, we do the same thing. From most liquid to the least liquid. But this one gets tough because we jumble things so close together. So property, plant, and equipment is all jumbled together. And so a building may not be all that liquid, whereas a piece of equipment, I could probably sell it on eBay in a matter of a few days, right? But we try to keep that structure. We generally do the physical assets like property, plant, and equipment first, and then the intangible assets after. Those are things like copyrights, patents, and goodwill. So let's talk a little bit about those. This isn't going to be an in-depth talk of each of these, but on the long-term assets, we report those net. And what do I mean by that? So if I have a building, I depreciate it over 40 years and we're 15 years into it, the value I will put on it will be the cost minus the depreciation I've taken on the building, plus any improvements that I have made to the building. And so I report those net. The same is true with my intangible assets. I will report those at the cost minus any impairments that I have or amortization that I have written down on those sorts of things. Now, let's talk a little bit about the limitation of a balance sheet, particularly the asset side of the balance sheet. And that is the biggest limitation is that many things are reported at historical cost. Now, I happen to be taking accounting right at the time when we just introduced a little bit of what we call fair value accounting. It's a lot more that way today, but things like buildings and equipment are still reported at historical cost. And so it's easy to see over time that may be a problem. An example of that is, if you're not aware of it, Lockheed, the giant defense contractor, bought a bunch of land, which in what is now the middle of downtown Los Angeles. It was kind of in the outskirts at the time, but in the middle of downtown Los Angeles, and they paid $50 an acre. This was just before World War II started. And it is still listed on their books at $50 an acre. Now, we know that any land in the middle of downtown Los Angeles is worth far more than $50 an acre. So that's one of the limitations of the balance sheet, is that we do use this historical cost for many items, and so it's hard to keep up with inflation. Now, we have had bad inflation, and of course there's talk about, will inflation come back? We got to about 20% a year at one point in the late 70s, early 80s. But there are countries that run much higher than that, 60, 70, 100% a year, and they do accounting differently than we do because of that. They have inflation adjusted accounting, and so that is taken into account on that sort of thing. So understand that the historical cost is a downside of U.S. GAAP accounting. On the liability side, the historical nature is not usually so bad because it is, we're going to pay it off for the historical value that we paid it off at. They don't get to write it up. Oh, we had 20% inflation. You owe 20% more on your debt. They don't get to do that, fortunately, yet. So liabilities are not near as bad as assets on that. Liabilities are listed kind of the reverse order, the ones we're going to liquidate the quickest, and into the longer term liabilities, and those are classified current and long-term also. Now, the thing you have to remember about that occurs in liabilities that does not occur on the asset side of the balance sheet is that a long-term liability will eventually become a current liability, or if you have something like a mortgage where you're paying part of the principal every year, there will be a current portion of long-term debt. And this can arise in a number of things. It can arise in bonds if you have what's called serial bonds. Serial bonds mature over time so that the company doesn't get hit with one big lump sum payment at a given point in time. Mortgage, of course, you pay principal and interest as you go along. You start off paying mostly interest and a little bit of principal. As you go along, you're paying more and more principal and less interest, but the payment remains the same over time. And so you have to list the current portion of long-term debt in along with the current assets. Now, on the owner's equity part of things, there are three broad categories that we will talk about in here. There is paid-in capital. This is what the owners paid into the company to get it started. Now, I don't know if you're aware of it or not, but if you buy stock on the New York Stock Exchange, you're not buying it from the company. You're buying it from another owner. And so if that happens, nothing happens to the company's balance sheet. Nothing happens to the company's paid-in capital when you buy it from another owner. This only happens, the paid-in capital only occurs when a company is getting started and the owners put in capital to begin, or when they do a public offering, either an initial public offering, IPO, or a subsequent public offering. So that's where the paid-in capital comes. Now, paid-in capital is broken down into two categories itself. There is par or stated value, and this is just really it's an arbitrary amount that the company puts on the value of the shares of stock. I did quite a bit of research when I was in the PhD program of where did this par value thing come from? And there's lots of people who have ideas and that sort of thing, but there is no like smoking gun. This is the idea of par value that I was able to find. And I found other people who pretty much said the same thing. They've looked and they can't find it. Probably the best explanation is that when the Industrial Revolution started back in the late 1700s or early 1800s, this was the value that the stock was, that the owners would try to maintain in the value of the stock, what was par for that stock to trade at. But pretty much the term par value, the meaning is lost to antiquity. And then there's additional paid-in capital, which is the amount that owners pay above the par value. So paid-in capital is split into those two categories. The second category, in intermediate 2, is when you will get into much more detail about the paid-in capital, that sort of thing. Then the second group is retained earnings. Retained earnings is basically the sum of the income that the company has acquired over the years minus any dividends it has paid out. And so retained earnings is one of those things you want to see growing over time. Now, an important thing to realize is that if a company does not have retained earnings, they have to get permission from the Secretary of State that the company is chartered in to pay a dividend because it's coming out of paid-in capital. Now, if you get to tax, if a dividend comes out of paid-in capital, they are tax-free. If they come out of retained earnings, they are taxable. You can't, however, the rules say you can't take it out of paid-in capital first and then so that you get a tax-free dividend. So it has to be paid out of retained earnings first. Now, there's nothing wrong with paying a dividend out of paid-in capital, especially if you're downsizing or liquidating a company over time. But retained earnings is where you're going to get most of your dividends out of. And then the last one that we have, and this may be new, is called accumulated other comprehensive income. There are a number of accounts that companies are responsible for yeah, or may have on their books that don't actually go through the income statement. So gains and losses from pension funds that they owe their workers. If they invest in assets and the assets go up in value, we may have a gain in the pension fund. Well, that's not going to show up in the net income of the company, but we put that in accumulated other comprehensive income. The same is true as if we have unrealized gains on available for sale securities. We don't put the gains into net income, but we do put it into accumulated other comprehensive income. And so that is going to show up on the balance sheet as well. Other comprehensive income shows up on the income statement, and then accumulated other comprehensive income, the sum of all those put together, shows up on the balance sheet. In addition to the accounts on the balance sheet, the assets, liabilities, and owner's equity accounts on the balance sheet, there are a number of disclosures that are required to make it a complete set of financial statements. So of the disclosures, one that is always required of every company is a summary of significant accounting policies. So this would be things like, what is your policy for writing down bad debt? What is your policy for depreciation? What is your policy on taking impairments? What's your policy on writing down inventory? Those sorts of things. So all those things are important, and it makes it possible for a reader of a financial statements to understand what's going on. Now, one of the things that we talk about is that financial statements should be understandable, but financial statements are not prepared for the average person walking on the street. Financial statements are actually prepared for what we call a knowledgeable user. And a knowledgeable user is somebody probably who has an accounting or a finance degree or some type of business degree and understands how to read the financial statements, because there are a lot of these policies and code words and things that go into it. All right, another thing that is a required disclosure is subsequent events. And one of the ones that we get around here quite a bit, we're in the middle of the oil patch out here in the Permian Basin. And one of the things we get around here is a company's drilling a well along about November, December. The year end comes. They prepare the balance sheet. Balance sheet is as of a specific date. It's a snapshot. And so on December 31st, we had this well that was drilling. Well, then on February 3rd, we find out that the well is dry. And so all that becomes an expense instead of an investment. And wouldn't it be nice if we told people that, yes, even though on our balance sheet we showed it as an asset, it was actually an expense or a loss because it turned out to be a dry well. And so subsequent events are very important. This also happens in lawsuits. We may have a lawsuit that meets the qualifications of a contingent liability. And then later that lawsuit is settled. So so on one date, we did not know a dollar amount, but after the balance sheet and the income statement is issued, we do have an exact dollar amount that we can list out. So we need to list those subsequent events in the disclosures. And then also any noteworthy events or transactions. One of the things that has to be broken out by SEC rules is if any segment of the company takes more than 10% of the total. So if you have a multi-segmented company, and that can be a geographic segment or it can be a business segment. So if you're into several different businesses, like say a General Electric, they may make medical imaging products, they make jet engines, they still make appliances, home appliances. So if you have different segments, if any single segment takes more than 10%, or makes more than 10% of the revenue or has more than 10% of the assets, that has to be listed separately in the disclosure notes. So that's important. Okay, so that's it in the things. Now, also in the financial statements, there are a number of other things that go along. There is the management discussion and analysis. This is the one area where management is allowed to kind of, we don't have to be totally neutral. The management can puff things out and say, weren't we great? We did this, and here's what we see in the future and how things are going to go. However, nothing that appears in the management discussion and analysis can contradict what's in the financial statements and disclosures. So they can't, blatantly tell you, oh, everything's wonderful and it looks horrible on the financial statements. So it has to be that. Another thing that is important to understand is management responsibilities. It is the management responsibilities to prepare the financial statements. Now, the accountants do it for them, but the management signs off on this. And either the CEO of a company or the CFO, Chief Financial Officer, Chief Executive Officer, or the Chief Financial Officer is now required under Sarbanes-Oxley to sign off on the financial statements that they are free from material defect to the best of their knowledge. And there are actually go to jail penalties if they lie about this. Prior to Sarbanes-Oxley, about 2002, 2003, they did not have to sign off on it. They just had to present them, and there was no penalties involved if they were wrong. Also has to be disclosed what the compensation for the board of directors is. They has to be listed. And then the top 5 executives, top 5 paid executives in a company have to have their salaries, name and salaries, compensation listed. That's why we know exactly how much CEOs and CFOs and various people make within a corporation. And the final thing that occurs is the auditor's report. And I want to talk, now you're at least 2 classes away, this class and intermediate 2, before you can take auditing. But one of the things I want to talk about, we talked about that the financial statements are the management's responsibility. The auditors just give an opinion. And basically, the opinion is written is pretty much boilerplate. They are all the same. The standard clean audit opinion is a 3-paragraph opinion. You can add to that various paragraphs that are also standard audit verbiage. You can add so the standard audit opinion says that we have tested this on a test basis. We don't examine every transaction. We use statistical analysis. And on a test basis, we find that there is no material error in the financial statements as presented. We also have to write about their internal controls. We did a test of internal controls and that we found them to be adequate. Now that's what goes into the audit opinion. So the management creates the financial statements. We just opine that those financial statements are basically correct. That's known as a clean audit opinion. That said, usually, auditors are going to be in communication with the company as they're performing the audit. And what generally happens, if a company cannot give a clean audit opinion, then the auditors get fired, because no company wants a audit opinion that says the financial statements are not worth looking at, and so or an except for. Now, the accounting profession provides for a clean audit opinion with an except for this one transaction that we think is booked incorrectly. We think the financial statements are presented fairly. Nobody wants one of those. It is in the accounting literature. It is there to be able to use, but it's one of those things that's a threat, not a reality. I have never in actual life seen an except for paragraph issued. You can also have a going concern issue, or a paragraph issue. We believe the financial statements are correct, but we don't think this company will be in business over the next 2 years. They usually don't issue those either. the audit firm gets fired before those get issued, or the auditor resigns. So the auditors don't, quote, make the company recognize certain transactions in a way. What happens is the auditor just resigns, and of course they still get paid for the work they've done. The auditor resigns the engagement if they can't come to an agreement on how various transactions will be reported. But it's important to realize that the auditor just gives an opinion. They do not actually prepare the financial statements. And the last thing I'll say about auditor's report, last thing in this chapter, is that a lot of people think that an audit report should detect fraud. The truth is, fraud is almost impossible to detect in the early stages if it is committed at the upper levels of a company. So if it's in the CFO, CEO, CIO, Chief Information Officer area that is doing the fraud, fraud is almost impossible to detect at those levels. And that's why fraud goes on for so many years. Eventually, what generally happens in a fraud case is that they've covered it up, done a great job covering it up, but then the economy goes south and then they can cover it up no more. So they do well, they can cover up a bad period, but when you get a recession or something like that, it becomes almost impossible to continue covering it up. And so that's where fraud gets discovered. One of the sayings is that the recession will detect what the auditors missed. Warren Buffett is famous as saying, when the tide goes out, we find out who was swimming naked. So that's chapter 3. You'll need to know the balance sheet. You'll need to know the classified balance sheet. And you'll need to be able to prepare a balance sheet from a adjusted trial balance. So good luck, and we'll start writing problems after this.